You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome to the show, Bob.
Yeah, good morning, Jim. It's Friday, and good to be with you.
You came up with a new term. Instead of a dead cat bounce for the markets, you called it a dead bank bounce. Can you explain that?
Yeah, that was Wednesday's piece. The banks have been beat up rather severely, and of course what seems to happen is in any financial mania, although the banks may be trying to be prudent and investors may have an idea that bank stocks are blue chip investments, but they always get caught up in the mania, and they're the intermediary on somewhere they get near speculators. And so what you had here is that in June, July last year, you had the credit spread starting to widen, which can be an indication of change in the credit markets. And you also had the yield curve change to adversity against banking. And, of course, they'd been bid up on the wonders of the yield curve. And it all began to change. And that's when we threw in the line there that bank stocks were a nice widows and orphans short. That was, I think, July 7th when we did that one. And what happened is that the credit spreads did continue to widen. In late July, early August, they broke out in widening, and that we contend pushed off the liquidity crisis that Shanghai was the main focus on, and that cleared. The first hit cleared at the end of August. And then you had relief, and then you had then in about December 22nd, credit spreads start to widen again, pushing off further selling, which the some of the big European banks were particularly vulnerable, and like Deutsche Bank stock just crashed. And they found stability and did do a brief bounce, and that's where we come up with the line. It was a dead bank bounce, and that was for the rest of the market. So it looks like on the big market, the S&P, that sort of stuff, is they might have the best on the bounce, although it was brief, maybe in the market. It could churn around a bit in here. We had looked for the pressures in, for example, base metals and energy prices to kind of reach their worst in January, more or less there, and then enjoy a rally out to at least into March. But because we played that seasonal game a few times, and last year it was really quite good. It went out until May. But there's too many problems out there. So, but within it you had, like, zinc did well on the base metal side, and you also had a terrific bounce in iron ore prices. They, as a matter of fact, for the last few weeks were going straight up. So but it didn't encompass all of the base metals or all of the commodities, but I think the best is in there, and let's just let it idle out for a while. Of course, what you have going on here is the knee-jerk on each sell-off in the big stock market. You get the rally in long-dated treasuries, and we were long until about 127 on the TLT, and then thought, well, this is good, but it might go a little higher. And actually it did. It then popped to 135, which was the high reached on the huge momentum speculation a year ago in January. It got up to 135, became extremely overbought, and then corrected for a long time. So, but let's just look at this academically. When you're in a liquidity problem, the flight really is to the most liquid items, and the long-dated treasuries, the liquidity there is diminishing, but there's still the urge to play that game, but somewhere it may not be as rewarding as people hoped. I mean, 135 was pretty good because I think the low was 113. But what you have here is that you have like crude oil reached new lows for the move at 26 a couple of weeks ago. You had the stock market, senior indexes, making new lows for the move. But with the long treasury, the TLT at 135, it did not get above the excited high price in January 2015. So it's been a good trade, but it isn't as hugely rewarding as it was hitherto. So
oil prices, some companies now and banks are putting out what they expect the price to be for the rest of the year. Husky Oil, very conservative, saying we're budgeting for $30 oil. Others are putting it as high as $50. Who's being more realistic here?
Oh, I think Husky at 30 is being appropriate. Mind you, it's very difficult for senior companies and executives at senior companies to take an outside-of-the-box stand, but no, I think Husky's being practical. They may be also talking annual averages, whereas, investment advisors like us, researchers and whatnot, we had a target, if it fell to a quarter of the high, which was probable, that calculated out to 27. But, it may end up being 27 may be the number on an annual average, which would be, it's one thing to have a trading low at 27 and a rebound back to who knows what. But if you end up going through a full year or the period of time at 27, that's going to do a lot of damage to a lot of producers. But that's the problem. You're in a post-bubble contraction whereby commodities are generally weak, except for when you're in a business expansion, which may be tiring now. But take a look at it, Jim, because you had the big cyclical blow-off in commodities in 2011, and they've come all the way down, although business conditions around the world have been moderately positive. So you had a cyclical bear market for commodity prices without a cyclical global recession. So somewhere something's missing. And maybe a cyclical recession globally will show up, and that would then match or at least, follow the decline in base metal prices. And the other one you get in a post-bubble condition is that the senior currency becomes chronically strong against, as we say, most other currencies for most of the time. And that is something that probably is perplexing the Federal Reserve, because their main job is to depreciate the dollar. And they really haven't been, because it's gone from, 71 or 72 on the DX in the crash, up to 100 a number of months ago, and now it's been sort of around 96. So that has been much stronger than the Federal Reserve would like. Their game is to depreciate it. It must be very frustrating for them, because what's been happening over these last 15, 20 years is that with a wild financial mania, this is not what they want. They live in a world that believes that if they provide credit or stimulus, that goes straight to business activity. But the public is the one who is really in charge of things. And if they decide they're going to speculate in junk bonds, that's the action. And then of course, the federal U.S. Treasury and the Federal Reserve got with the program and bought, the Fed was buying these mortgage bonds, backed bonds, the really ugly stuff. So the experiment's not over yet, but we should look at it as that all central banking has been is an experiment run by some intellectuals who have intuitive ideas that if they provide stimulus, they'll get GDP out of it. But that was never seriously researched. It was just more intuition than research. But they got the hold of the reins of control. They aren't going to give up. But somewhere the public will wise up to it and begin to move against the preposterous privileges that these central bankers have. The condemnation of central banking is not just a mood. This is based upon, 300 years of history of central banking. And what we concluded a long time ago was that the financial history itself is a due diligence on the theories and practices of central banking. And they're hopeless, absolutely hopeless. And maybe we should hope that the Federal Reserve, it should be a publicly traded stock, so then we can short it. Be wonderful.
Well, the Bank of Germany says it does not want to see more stimulus. That's what they told the G20 meeting in China, is that, it's been a disaster so far. Why make the disaster worse?
Now that's somebody starting to learn from recent history. Pleased to hear that one.
But is Germany the lone voice in the wilderness?
Well, you never know. These central bankers in office have their reputation to protect for posterity. And if they're there pushing an absurd theory when it all comes apart, they're not going to look good. So maybe some of the wiser ones are beginning to think, hey, I want to get on the right side of history on this thing. And eventually, this is beginning to happen in global warming, for example. There are some serious researchers are now finding the nerve to get up and say that the research behind the theories of global warming is not that sound. So you've got perhaps two endeavors out there where certain leaders will realize that they have to be on the right side of the story as the story's changing. So we live in very interesting times. Now on the gold, which we enjoy trading, that was part of the bottoming process, we talked about in November, and advised accumulating some gold stocks on weakness, and then again in January on the big hit in the first trading month of the year. And the Hoye, I think from extreme low to extreme high, was up 63%. But you can say maybe there was a 45% gain in the move, and that's terrific. And but we didn't have a full position. We had some, and haven't advised lightening up on any of this, because I think we're just early stages of a cyclical bull market for the gold mining industry, where profitability will increase, and we prefer the stocks rather than actually positioning gold itself.
Goldcorp announced a huge loss in the last quarter. Is that just a write-down?
Yeah, on the boom, you had virtually a decade of a boom for gold that ended in 2011. And in the excitement of a boom, participants will do many foolish things. In the case, some of the senior golds were in areas, regions, countries where you had political risk. They were also in locations where you had maybe severe problems in terrain, maybe other areas where you might have had some metallurgical problems, but it was full steam ahead, let's go, we got to be playing the game. And then, of course, it all came apart. So hopefully this is the end of announcing that we're writing all the bad stuff off. Then analysts, in looking at the industry, can just look at operating earnings. And with the price of crude oil so cheap relative to gold, that represents operating margins, because you have to buy, in the gold mining business, you have to buy energy one way or the other, blasting agents and all that sort of stuff. So it should be coming through with increasing prosperity for gold mining. And this is where we like to emphasize that investors should be looking at the positioned in the gold stocks. So this is where, if start of early stages of a cyclical bull market for the gold mining sector, then you're in the world of buy the dips. And of course, this is counter to what's going on in the senior orthodox stock markets, where it's in a bear market, in which case you sell the rallies. It's interesting. And even on a day-to-day basis, Jim, you're getting opposite action. You know, like today you got positive in the stock market and you got negative in gold. So that's the way it works.
We'll have more with Bob Hoye right after the break.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Bob Hoye. In Japan, where they brought in negative interest rates a few weeks ago, the public reaction has been withdraw all their cash from the banks, where they'd have to pay to keep it, and store it at home. They've had a run on home safes. They've sold out. And in Japan, apparently, my correspondent there telling me, James Corbett, that in Japan, cash is still king. He says it's not unusual for someone to plop down 20 grand in cash to buy a car. And they do a lot of transactions in cash. So their reaction is, I'm going to hoard my cash at home and screw paying the banks to hold on to it. So if they were expecting an economic stimulus from it, they didn't get it.
No, there was another theory. They've got this idea that the reason why their theory that stimulus always prompts business activity is not working is that people are, now what are happening is holding cash. And that was the same in the 1930s. They had anti-hoarding movements inspired by the government, where retail merchants would have a little sticker in the window about "Don't hoard your money." I've been trying to find an image of that, but I haven't been so far. But yes, they think now the fault with their theory is that people are deciding to hold cash. But the way the big speculative moves work is that you go back to the 1970s, where speculation was in hard assets, commodities, wholesale prices, and also wages became very speculative, and that drove the CPI up to, in the U.S. to 15%. And then that speculation was over, and it led to speculation in financial assets, which is still going on. So you move from hoarding of things, which was the 70s, then hoarding of financial asset, and this is now like the late 1920s where they hoarded financial assets. Then you go into the 30s, into the post-bubble contraction, and the feature is the public hoards cash, and it drives the theoreticians who have faulty theories mad. They're frustrated, so they will try and penalize cash hoarders some way, one way or another. But I don't see in the U.S. coming in and confiscating gold like they did in 1933. So no, the world has moved away from that type of authority, and but the world will be. I think the public will eventually reject the notions of central banking, and they'll sit down and look and say, look, you spent all our tax money, and here's the result. You didn't change history one bit other than the rate of depreciation of currency. So I'm looking forward to it, Jim.
Well, you had Stephen Polos devaluating the Canadian dollar when oil was at its height. What was he thinking?
Oh, it's just knee-jerk stuff. They think that, as I say, they think that stimulus and currency depreciation is plus. The public is capable of rejecting all of this, and I think it will happen.
Yes, unfortunately, there's no training camp, though, for politicians, and they're the ones who follow the lead of the central bankers. Yeah,
well, I look at it. The bureaucracy is trying to run things. It likes to live the good life and create jobs and empires and everything else. And the politicians, they're just a sales force for the bureaucracy. And right now in Canada, with the Liberals in office federally, they've got a great sales force for the wonders of government. You've got province of Ontario, which I think the identified around the world of all of the sub-sovereign boroughs like state or province. Ontario is the worst ever. And now you have the same political ideology as has been governing Ontario for the last 15 years, is now in office federally and is doing the same thing. They're right. They have no controls. And Peggy Noonan in the Wall Street Journal has come up with a really good phrase about the protected and the unprotected. And the protected are those that are living the good life as the government expands. And so you've got the lawyers and the politicians and the civil servants. And you have the unprotected, which is the great ordinary people who don't have those protections and are preyed upon by the state. I intend to follow this up. It's the protected and the unprotected. And so I think things are shaping up for another great reform, such as in the 1980s, when people in Eastern Europe and communist countries looked at the promises of the governing classes, looked at how well the governing classes were living, and then looked at their own standards and said, hey, this deal isn't working, and they moved to shut down communism, and they were very successful at that. But now what you've had in the last decade is a huge expansion of government, not under the banner of communism, but under the banner of, we'll make things better, and we're going to fix the climate, all sorts of things, but it's still the same old. And it allows those who are part of the team, bureaucrats and politicians, to live well on the backs of those whom they tax or steal money from through currency depreciation. So we live in very interesting times, and perhaps as a global recession comes in, there'll be enough folks around the world look at the promises of their governing classes and the results, and we could have another wave of reform, such as the one that brought down the Berlin Wall in 1989.
Well, someone said if minimum wage is so great, how come politicians don't pay themselves minimum wage?
Good one, Jim. Good one.
Bob, thanks a lot for chatting with us.
Always good to be with you, and we look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Check out our YouTube channel, Talk Digital Network. Find us on Twitter at Talk Digital Net. You can forward questions or comments about the show to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.